As concern over a U.S. debt crisis has grown over the last year, I've been digging deep into Treasury auction data to see what the underlying trends are really showing. In today's video, we're going to go over my latest research, some concerning trends, and why things currently aren't as bad as the media sometimes makes it out to be. Let's get into it. In my last video on what's happening in the bond market, I highlighted a concerning trend I found in the Treasury auction results for the 20-year bond. Looking at press releases for Treasury auction results, I can calculate what's called the bid-to-cover ratio, which gauges the level of demand at a given auction. I was looking at the 20-year bond first because there was a reportedly weak auction on May 21st that caused a stir in the media. That particular auction didn't turn out to be that concerning in a larger context, but it did prompt me to take a broader look at those 20-year bond auction results over time. You can check out that last video if you want to learn more about my approach to this data. I'll leave a link to it in the description down below. But even if that May 21st auction wasn't particularly concerning after all, I did find a concerning trend that had been developing. Here's the bid-to-cover ratio for the 20-year bond going back to May 2020, as well as the high yield for each auction. This is a pretty volatile series, so I like to smooth it out with a 12-month trailing moving average. You can see the problem here. As yields have been going up, the bid-to-cover ratio has been trending lower, which means demand for 20-year bonds has been going down, even though you can get a higher yield. If this trend continues or intensifies, then we could indeed see a true crisis in the bond market. If demand continued to weaken, the yields would likely need to increase even more just to keep investors in the market. Higher yields makes it more expensive for the government to borrow, and more spending would have to go into paying interest, which necessitates borrowing more, and you end up in a dangerous downward debt spiral. But there are some unanswered questions here. I only have data on the 20-year bond going back to May 2020, and that's because it was the first time that the U.S. Treasury Department began to issue them since it was retired in 1986. Without a longer history of data to check against, I don't know if the falling demand is because of real weakness or perhaps it is merely returning to some long-run average that is lower than where demand is now. To help answer this, I started compiling data on the 30-year Treasury bond because there is a much longer time series to work with. Here's the bid-to-cover ratio for the 30-year Treasury bond since May 2020, the same time period as what we are looking at for the 20-year bond. Again, it's a pretty volatile series, so I'll smooth it out with the 12-month trailing moving average. We have started seeing a similar trend here with the 30-year bond in the last few months. The bid-to-cover ratio has started trending lower, even though the auction high yield has been trending higher. It hasn't been happening as long as the 20-year bond, but we're still seeing it. Now let's look at a bit more history to put this into context. Here's the smooth 30-year bond bid-to-cover ratio going back to 2009. The first thing you might notice here is the huge surge in demand after 2010. That is largely due to the Federal Reserve's quantitative easing program in the wake of the global financial crisis and Great Recession. If we ignore that and just look at the historical trend, the bid-to-cover ratio is actually at a relatively high point. Even now, demand is as high as it was back in 2015 as the Fed was winding down its quantitative easing. So when we look at this from a historical perspective, the current demand for long-term Treasury bonds, as measured by the bid-to-cover ratio, is actually pretty good. Definitely no sign of an impending bond market crash in the immediate future. Now, that doesn't mean that there isn't a risk of one. The debt situation for the U.S. government is not good. We currently pay more on debt interest than we do on national defense, and the current trend of fiscal policy suggests that interest payments are only going to get bigger as we borrow more. So this is what I'm seeing at the long end of the Treasury market. Another question I have is, what does this look like on the short end with the 2-year Treasury note, for example? I've already started compiling that data for those close, and we'll have another bond market update for you soon. If you want to stay up to date on some of the best bond market analysis on YouTube, make sure you are subscribed to this channel and hit that notification bell down below so you won't miss my next video when it comes out. And if you think doing multiple hours of data entry for Treasury auction results is simply the most fun thing you can do in your spare time, go ahead and hit that like button down below. Thanks for stopping by. I'll see you in the next video.